Why paying tax is not a bad thing. I'm Dean from the Workshop Whisperer. This is the original Workshop Whisperer herself, Rachael Evans, in today's episode of Talking Shop as we approach the end of the financial year. Rach, tell us, why is paying tax not a bad thing?
Well, we've got in Australia coming up to 2 months left in the financial year, and if your accountant is worth their salt, they will be having a tax planning meeting with you shortly to have a look at your overall tax position of the business and for you individually. Now, we've heard many times over the year, I've had it said to myself with some previous poor accounting advice, that you should run out and make a purchase to try and get down some of that profit so that you don't have to pay as much tax. Now, it's common, but it's short-sighted, because what it means is you are using income that could have started to be your stockpile for the next financial year of cash to fund your business, but instead you might have been encouraged to go and buy a hoist or even a vehicle, and all in order to show that you had disposed of some of the income that you had made throughout the financial year. And the deductibility of whatever it was that you purchased is not equal to the dollar that you spent. So it may reduce the amount that is shown on your profit and loss, and by a fraction the amount of tax that you pay, but that money is no longer available to you to run your business. So when you think about it, it's kind of a little bit of madness.
What's that line? Buying things you don't need with money you don't have to impress people who don't care. But you lose out at twice, because it's capital you no longer have, and the value of the asset that you've bought only depreciates over time. Anyway, this is not to say as well, and we're not accountants, but this is not to say that you just stockpile a whole bucket load of cash that you don't make work for you either, is it?
No, but having a war chest, which is something that we work very closely with our engine room clients on pretty much from the moment that they come through, having, after you have reduced any outstanding debts, whether that's vehicles, equipment to the tax office, having the ability to start piling up 3 to 6 months worth of operating expenses is the sign of a profitable business. So just because the black and white on the profit and loss is saying there's a profit there and your accountant wants to reduce your tax, doesn't mean that that is the best thing for your business over the next 12 months. So while I'm not suggesting that your accountant doesn't know what they're doing if they do suggest that to you, I am suggesting think longer term than what they are, because they get their gold stars in their mind by helping you pay as little tax as possible, but you've got to think beyond and into the next 12 months, 3 years, 5 years, and what you want your cash flow position to be.
So there we go. Let's not get caught in buying stuff to pay less stuff.
Ends up costing us more stuff.
Let's just extend our vision a little bit and go, okay, well, what else can we be doing to reduce our tax liability, but also building future wealth? We'll see you on the next episode of Talking Shop.